part 2 of our Spotlight Series podcast. What we thought we'd do is address some of the noise coming out of China with respect to the new potential regulations in its fintech space. And of course, many of you will know that in early November, the impending IPO of Ant Group was suspended, and now it's not looking like it will happen until 2022. In fact, this is going to be the world's largest IPO at around $40 billion. They were not having any trouble raising that capital because I think there were more than $3 trillion of bids from Chinese retail investors. So this was a really big deal, and it was pretty newsworthy, to say the least, that the IPO was suspended. So why don't we start there, Chris? We did, of course, take a look at Ant Group and consider whether or not to bid on it in its IPO before it got shelved. For those who are interested, we actually chose not to do that. So Chris, why don't you give a brief summary of the Ant business and why we chose to exclude it, and then we can talk about some of the new regulations which are maybe layered on by Chinese regulators.
Absolutely. So notwithstanding the competition, $3 trillion worth of competition we would have had in getting an allocation in that Ant IPO, we did have a look at the company. And the reason we had a look at it is because it's an exciting company, and it's in a very fast growing space in China in the digital payments and financial technology space. There's 2 parts to the Ant business. On one hand, you have Alipay, which is the largest digital payments provider in China. And that market is a 200 trillion renminbi market, divide by 7 if you want dollars in that case. So it's a $30 trillion market. And it's a 2-horse race that Alipay leads with a 55% market share. The rest of the market is tied up by another large internet company, Tencent's Tenpay offering. And that marketplace is set to double over the next 5 years. So there's some really attractive and exciting attributes to that marketplace. And Alipay makes its money by taking a very small clip or share of all of the transactions that are processed over its platform. At the end of the day, though, it doesn't make very much money at all from doing that.
And that's, I think, hasn't really been talked about nearly enough. You know, you've got a 200 trillion renminbi or $70 trillion US dollar market, and you've got a 55% market share. You would think, how can you not make money? And yet this thing really doesn't make any money. So
doesn't make some call it free parking, and they use it to try and feed the other side of their business,
right,
which is their financial technology business. And primarily what they're doing on that side of the business is originating consumer and small, medium business loans online. And they're partnering up with banks, regional banks, city banks, some of the smaller banks in China to fund those loans. And again, similar to what they're doing in Alipay and their payments business, they're taking a small slice of that loan and pocketing that, and that's where they're making some profits.
So they're essentially acting as a customer acquisition kind of platform for banks.
Absolutely.
And so they'll leverage their data to try to assess, which customers are the best borrowers and size them up, and then essentially do all the heavy lifting and then just farm off the loan to the bank.
And that's the attraction for the banks. It's a very easy way for the banks to access 1 billion customers. There's 500 million different consumers have received loans through that platform, through Ant Group's platform. So it's a great way for banks to access that distribution, and it's also a great way for them to harness the data that Alipay brings, not just their own data around consumers and the payments that they're making and their credit history, but they also have an agreement with Alibaba and the e-commerce business, the largest e-commerce business in China,
which owns a third of Ant Group. So
which also itself owns
a relationship.
Business. There's a really strong relationship there, but between the distribution and the data, it's a really attractive combination for the banks to partner up with Ant Group to originate these loans, get access to the customer base, and Ant gets to take a small slice of that on the way through. So that's how they're monetizing.
Okay, so there's probably a few members of the audience sitting here right now saying, well, that all sounds pretty good. So, so what's the problem?
Well, it is all really good, but we also identified a few concerns in there. Now, I'd say commercially, one of the key concerns that we had is the way in which they monetize this business is to take that small percentage of the loans that they write with the partner banks. And on our analysis,
so a percentage of, are you saying a percentage of the spread that they can charge?
So, and look, so where does this end up coming to bear is that the banks charge an interest rate.
Yep.
They have to pay for their funding. There's a small spread.
So there's a profit sort of spread. That's
Absolutely.
how the banks make their money. Yeah.
And Ant Group takes a share of that.
A piece of that. Okay.
The problem is the problem for them, and it's a nice problem to have, is they've already taken a considerable share of that spread. So there's very little.
Right. So how much can that expand? Probably not as much as.
And that was a question for us. Right. So we had a question mark over that. And as time goes on and growth in volume start to moderate, there wouldn't be any growth in what the business could end up charging its banking partners. So that was a key concern for us on the commercial side of the investment thesis. It also wasn't obviously cheap to us.
Yeah.
Okay, this is a business that at the proposed IPO price was going to be worth over $300 billion, which is more than most banks in China and the United States today. So it wasn't an obvious bargain.
Yeah.
But then more importantly, I think where we had our greatest concerns was on the regulatory front. So there's potential for the market regulator to open up access to other players, to other payments providers, other fintech providers that would create more competition, more pricing pressure, and potentially a loss of market share in time. But I think the biggest regulatory risk that we were worried about came in the form of Ant Group having to co-fund the loans that they were originating with their banking partners.
And this is exactly the noise that has come out of China just in the last few weeks, and is the specific reason why the Ant IPO had to be suspended. Because of course, if Ant all of a sudden now needs to hold capital against all of these loans, or some of these loans on their balance sheet, then the value of that business's equity is materially lower than it was yesterday when they didn't have to hold any capital.
And the proposed regulation is that Ant now might be looking at having to fund 30% of the loans that they originate, so 30 cents in each dollar of every loan. They probably have to set aside some capital, or at least some level of loan loss reserves, in case any of those loans go bad. And so far, they haven't had to do that. So they've been able to grow in what we'd say is a capital light manner, not having to set aside any shareholder funds to support the tremendous growth that they've had. But that all might be about to change. And it changes the profitability of the business, it changes the returns, and it also moderates the growth profile.
So with the stroke of a pen, and that's if the stroke of this pen does actually happen, because nothing has been formalized. There's just a lot of noise and suggestions. But with the stroke of a pen, should that happen, the value of Ant becomes materially impaired compared to where most of those investors thought the value of Ant would be. So look, that's a really big deal, we think, and something that investors should be aware of. I would say more generally, our view of the technology space in China and with respect to its interaction with much of the rest of the world is that it will continue to decouple along this dimension of technology. Without going into each issue specifically, we do know that Huawei has been banned from many countries' 5G networks. We know that TikTok has been banned in India. Amit, I'm assuming you've still got family back in India. TikTok's
Yeah,
not allowed, including a number of other Chinese apps.
yeah, it was a big deal. I think TikTok had over 100 million users in India when it got banned. So it was a bit of a shock. And then I think another 200 apps were also taken down, Chinese origin in the country.
So even in the US, there's talk of TikTok being potentially banned in the future. Even WeChat, there was talk of it being banned. We know that here in Australia, Prime Minister Scott Morrison was censored on WeChat just a few weeks ago. So that raises questions, will the Australian government take action against any Chinese apps? So, and then of course on the Chinese side, it probably goes without saying that many of the apps that are loved outside of China are already banned in China. So whether it's Facebook or LinkedIn or Twitter, all of those are blocked in China. So if you take a step back, you would have to suspect that a world in which there's kind of a Chinese ecosystem and an ex-Chinese ecosystem from a technology perspective is something that's very possible. And through that lens, that's why from an investment perspective, we definitely favour those businesses who are in one camp or the other. You know, Microsoft, Amazon, Facebook are all in sort of dominating the world ex-China, and then businesses like Tencent and Alibaba do derive substantially all of their revenues, or certainly most of their revenues, from the Chinese mainland. And we would be more concerned about technology businesses that had significant cross-border transactions in that respect.